Okay, let's dive right in. We're going to put on our analyst hats today and break down the latest and pretty rough earnings call from Updater Services Limited, or UDS. You see, their growth story just hit a major speed bump. So our job is to figure out, is this just a temporary pothole, or is this a sign of something fundamentally broken with the company?
So here's how we're going to tackle this. First, we'll look at the story they were telling us, the original investment thesis. Then, we'll crash into the reality of this quarter's numbers. We're going to do a deep dive into the problem areas, see what management says they're going to do about it, and then, most importantly, we'll outline the key risks that should be on every single investor's radar right now.
To really get why this quarter was such a shocker, we have to rewind a little bit, back to the end of last year. The picture management was painting was very, very rosy, and it formed the core of why anyone was investing in UDS in the first place. I mean, listen to that. The tone was pure confidence. They were basically telling the market, hey, we've got this. We are a well-oiled machine firing on all cylinders. This was the narrative of a super reliable, high-growth company. That was the story. And then we get to this quarter, and that whole confident narrative, it just completely fell apart. The story took a massive, unexpected turn, and it's forcing everyone to rethink the entire investment case. And wow, look at this contrast. This is really where the rubber meets the road. I mean, the guidance cut is just staggering. They went from dreaming of 15% plus growth in their key BFS segment all the way down to just 3 or 4%. That is a massive crack appearing in the company's story. And the numbers here, well, they tell the story. Their main facilities management business, IFM, it held up okay. But the business support services, or BSS segment, just hit a brick wall, growing only 1.5%. That's what's dragging everything down and crushing their profit margins. So the big question is, what on earth went so wrong so fast?
Well, the answer is that all the trouble is coming from that BSS segment. And this wasn't just one single problem. Oh no, this was a perfect storm. A whole bunch of different problems hitting multiple parts of their business, all at the exact same time.
First up, and probably the most worrying, was the bombshell they dropped about Yvonne, their logistics business. Management admitted there were, and I'm quoting here, lapses in thorough due diligence for a few customers. For an analyst, that kind of careful language just screams red flag. And we are not talking about a small lapse here. This is a huge deal. We're talking about a massive 280 million rupees in payments that are now being questioned and might never get collected. This immediately makes you ask some really serious questions about their internal controls, their risk management, their overall governance, really. Okay, next up, Athena. Now, this business used to be one of their high-margin stars, but in just the first half of this year, revenue completely collapsed by a staggering 20%. And why? A key client just decided to take their business in-house. This is a classic example of client concentration risk, and, well, it just came home to roost. And the pain just kept coming. Over at their Dinove business, a huge tech client slammed the brakes on spending, which squeezed their margins. At the same time, their background check business, Matrix, is still getting hammered by the hiring freeze in the IT industry. That's a headwind they hoped would be gone by now, but it's only gotten worse.
So the company's basically on fire on multiple fronts. What's management's plan to put it all out? Well, they're aiming for what they're calling a soft landing. But honestly, the path to get there looks pretty treacherous.
Okay, so here is their 4-step playbook. Number 1, they're going to tighten up controls because of the whole Avon mess. 2, they're going to try to diversify their customers so they're not so reliant on a few big ones. 3, they're going shopping for another company to basically buy some growth. And 4, the classic response, cut costs everywhere to try and save what's left of their profit. All right, this is absolutely crucial. As an analyst, you have to forget that old growth story. It's gone. We are now operating under a completely new, much more cautious, and much riskier investment thesis. The old story is broken. This is the new reality we have to deal with. So what are the big questions now? What are the things that should be keeping us up at night? Well, getting that Avon money back is a huge one. But the client risk at Dinave and those IT headwinds are still major problems. And honestly, the biggest question of all towers over everything. Does this Avon disaster point to a much deeper, systemic failure in how this company is run? And if you were looking for some reassurance from management on that, well, you are not going to find it here. This is a very candid, but also a deeply unsettling admission.
They're basically telling us they might not get all that money back and that more financial pain could be on the way. The uncertainty here is just, wow.
Which leaves us with the ultimate bottom line, the multi-million-dollar question for anyone looking at UDS right now. Was this just one truly disastrous quarter, a perfect storm of bad luck and bad timing? Or had the events of the last few months fundamentally and permanently broken the company's growth story and its investment case? That is the question.